This week we're going to be discussing many themes, but they all include expats and they all include expat tax liabilities and the changes that are going on around the world, including in the UK with a budget announcement later today, but also around the world with exchange of information which are impacting business and property rentals and investors and expats living and working abroad. So watch this show, follow us at projectpartnership.com and at the Living Working Abroad show. We've also got a Twitter space where you can listen in each week, ask us questions, and we'll get back to you and answer you straight away. Thanks a lot. On the Living Working Abroad show, over the last few months, we've been discussing overseas property rentals and the impact of that on people living and working abroad. And it's quite a significant area of issuing, of change. What governments around the world are doing with anybody that owns overseas property, whether they're expat or not, whether it's in their home country or another country, you're finding that licenses for property rental are being introduced, and these licenses give access to the authorities of the tax information of the beneficial owner of that property. So if wherever you are as an individual tax resident is irrelevant, where the property is, if it's registered and you're receiving rental income through the licensing arrangement, which you may have with Airbnb or Booking.com or your local property rental agent, it leads to an exchange of information into the tax system, which may be in the local country where the property is, but will also come back to the address and the tax registration of the beneficial owner. So as your bank, as your employer, as your property rental agent asks you for your tax number, they're declaring who the beneficial owner is, and that leads to a potential tax liability. The only way to resolve that is to make the correct tax returns for your circumstance, but also talk to a tax advisor about strategies you can use to minimise your tax liability by maximising allowances and expenses for that. And that's what we're talking about here today in the Living and Working Abroad show. In the UK, property rental is treated as an income for income tax purposes, but in other countries that's not necessarily the case. You may not have a personal allowance against that property rental income, and it could be a flat rate tax. So in Italy, for example, the tax on property rental is 21%. In Cyprus, they've got little taxes, which are again at a flat rate of 2.6% or 3%, depending upon the circumstances. That means that no matter, even if you've only got £100 of income, you've still got a potential tax liability in that country. So in England, an expat could own a property rental and have a net income of 12,500 or lower, and that will be income tax free. For a couple owning a property and renting out separately, they've each got their personal allowance, so it's £25,000 income tax on property rental before an expat could pay tax. So it's a very good income tax source in the UK. But other countries with a flat rate tax reporting, there may be just a little, but some tax to pay. Countries like Cyprus, Italy, Spain, and the UK all require a tax return if you've got any income. So it's irrespective of whether you're a tax resident or not. If you've got taxable income in that country, such as Cyprus or Italy, Spain or the UK, then you're still required to do a tax return. In other countries, if you're tax resident, then again you must do a tax return. So in countries like Portugal and Cyprus, if you're a tax resident, then you must do a tax return. So for Cyprus, this is a change. So from 2023 onwards, anyone who's tax resident with any income has to do a tax return in Cyprus. So if you've got any income in Cyprus, you have to do a tax return. If you're a tax resident in Cyprus, you have to do a tax return. This is a new rule. It's a new regulation for 2023 onwards. And for more information and guidance, contact us at proactpartnership.com. Thailand are changing their regulations as well. They had a slightly different system where you could just have income taxed on a remittance basis, but that's gone now. As soon as you remit income and as soon as you're tax resident for more than 6 months a year in Thailand, from 2024, you have to do a tax return in Cyprus. For more information and guidance on expat tax for overseas property rental and income, and for expats in general, contact us at proactpartnership.com. Next, for expats, we're going to look at the UK, and many of our clients are UK expats living and working abroad, but they have an influence back in the UK, but there's lots of people living and working in the UK as well that are expats there. And the first thing we want to discuss now is the UK economy being trussed up. There's been lots of toing and froing over the last few years within the UK with changes of direction with political governments. We saw in 2009 the current political party being elected on a mandate of post-Brexit deregulation from EU heavy regulation to post-Brexit lighter regulation, global trade and lower taxes. That all came crumbling down based around COVID and a change in government in effect by the elected MPs of the government elected somebody new that wasn't elected in a general election, and the policies that they've applied within the economy have been a different approach altogether, and we're potentially seeing a change of that in the run up to a new election coming forward. What Liz Truss government did, which was a second iteration of the current parliament, was they proposed to cut tax and reliefs and cut regulation to boost growth. And that was thwarted, and she was thrown out of power within a very, very short matter of months, even though being elected by a national, albeit internal party election, she was thrown out of that because the establishment reacted against her to say that by cutting taxes now and providing a business incentive reliefs for growth, that would increase debt, which was a bad thing. This is what was ruled, on top of all the debt that had been incurred subsidising COVID, whether that was for the good or the bad. And that saw her out of power, and saw the same government change tack to increase tax quite significantly, which has kind of led to a slowdown of the British economy and more regulation, which has led to an exodus of people wanting to relocate overseas or move abroad, and led to higher corporation tax. So expats using a personal service company in the UK have seen potentially higher taxes and insurance. Now we see potentially, with a potential change in the general election next year, the government changing tack again, and what they're planning to do on the 22nd of November is to do an autumn statement, which will affect to be the pre-election budget, where they're going to go for the post-Brexit election pledge of less regulation and less taxes to try and get growth going ahead. We'll have to wait and see how that runs, But for expats operating a personal service company in the UK, it could mean a lower taxes and a better and more flexible environment for people. Liz Truss was possibly, and in effect they're also doing what Liz Truss was proposing, so she may have been right all along. That remains to be seen. It's politics and it's a different approach. An EU-led heavy public sector and high taxes and regulation against a lower tax, more nimble economy. These are the changes that are coming. Will the trussed up UK economy be released to go forward with more dynamic growth for investment within and overseas? We'll find out later, and follow us at the Living, Working Abroad show to see the impact of the budget statements and the regulatory changes on expats that are operating from a personal service company based in the UK. Winter is coming. As we come towards, in the Northern Hemisphere at least, the end of the calendar year, we know that winter's coming. And in the UK, as well as in America, elections are coming along next year, which could radically change the approach. In the UK, we've had over the last 20 years an economy which has been developed by a new Labour approach of more benign public spending and higher costs, which have crept up, increasing public debt and public spending, which has all been thrown up in the air with the excessive spending and public subsidies of the COVID era. And despite the election of a tax-cutting government, they have increased taxes and created a situation where it's just carried on with the Blair-Brown years through to 2023. So which way are we going to go? In 2024, the UK could go back to reinforce and further ingratiate the Blair-Brown approach of higher regulation, higher public spending and control, or it can move towards a low tax, deregulated economy with a global aspect in dealing and trading overseas, which could benefit expats in a wider field rather than just benefiting people trading within the EU. There's also potential with after the next election that Britain could end up going back into the EU either as a full member or as an EEC member, in the same way that Norway and Switzerland and Iceland have got an affiliated membership of the EU, where they follow EU regulations, but not necessarily all of them in a slightly looser framework. This all remains to be seen. In effect, the autumn statement that will be made on the 22nd of November is a pre-election budget and a pre-election giveaway, and they can give it away because potentially they've overtaxed in the past. And does a political government want to cut public spending over 10, 20, 30 years when they need to be elected every 5 years? And generally the record over the last 50 years in the UK and America and any other country is no. Winning the election is everything. But the good news is that the UK have introduced some incentives, and they're potentially going to develop and expand those. One, for anybody operating out of a UK personal service company or a UK business, is that any expenses, any developmental expenses are going to be fully expensed as a current year. So rather than spending £10,000 on a capital asset that is depreciated over 2, 3, 4 years, that 10,000 capital expenditure can all be tax deductible in the year of spending. So UK business that want to expand into an overseas branch or employ workers in another location, the investment in that additional expense can be tax deductible from the a UK personal service company directly. Personal service companies work really well for expats living and working abroad because it gives them potentially a maximum corporation tax rate. So you've got a flat rate tax that can be paid, and then dividends are paid out of that business tax, that's business income that's paid corporation tax. So you've got a flat rate tax on your income as a personal service company, expat living and working abroad, and potentially you could be living and working in a jurisdiction where dividends are not taxable. So in Portugal and in Cyprus, an expat living and working abroad from receiving dividends from a UK business has 0% tax liability on those dividends. So you can pay yourself a minimum income in the UK and a flat rate corporation tax rather than an incremental tax rate, which might take you up to, say, 45% in Portugal or Spain, or 35% in Cyprus, or 45% in the UK. A corporation tax rate is a lower flat rate and with fully expense for the business development and how you're running a business cross-border within Europe and around the world. In addition, the UK are talking about reducing national insurance. When you talk about a corporation tax or a flat rate tax or an income tax, people choose to ignore national insurance. Now, national insurance does pay for things. It pays for healthcare, it pays for benefits, and it pays for pensions. But in the UK, an employer has to pay 28%. There's up to 14% employee national insurance and up to 14% the employer national insurance. So 28% of every salary, every £1,000 of salary paid, another £280 in national insurance is paid into the coffers. That makes employing people and developing and investing in growth and people all the more challenging, which is why we see unemployment rates stubbornly high despite the need for labour shortages. So potentially we could see those taxes cut for business as well, which would mean that a UK business could employ more people remotely and from the UK to develop their business living and working abroad. Follow us on Living and Working Abroad show and at proactpartnership.com. You can contact us for help and guidance on how to strategies to maximise your tax savings as an expat business living and working abroad, or as we said earlier, for your property rental income overseas. As we come towards the end of November, there's around 69 days left to complete UK tax returns for expats living and working abroad. There is a paper deadline for the UK, which is in October, but the actual deadline for submitting a tax return for anybody in the UK is the end of January. It's just that after the end of October, it has to be submitted online. So there's a short period a few years ago, where you could only submit it online, but they went back to paper but gave it a shorter deadline if you want to submit your paper by the end of October. But you've still got another 3 months to submit that online, which gives you time to collate your income and prepare your year-end accounts and get your statements from your property rental agent, your employer, and any other and your dividend income and any other income that you've got that needs reporting in your UK tax return. So a private partnership, we're full on doing UK tax returns for expats for the year ending 23. If you still need help and guidance completing a UK return, including claiming a split year for that year to reduce your UK tax and maximise your allowances, get the maximum rebate you can from being overtaxed in the UK. These are the things that Proactor are experts at, so contact us at proactpartnership.com. 69 days is no time, there's not long, whichever way you want to consider it. the days are counting down. Each day there's one day less. So the sooner you ask for assistance, an expat has to complete an online return. They can't do it on paper anymore. The deadline's past at the end of October. You can't use the HMRC website because that software doesn't work for expats, not residents. Prior to expat experts for tax in the UK, whether it's property rental in the UK or any other capital gains or income arising from the UK, contact us at proactpartnership.com. Over the last 8 years, Proact have been discussing the exchange of rules regulations, and those have changed and developed over the years, and many countries have brought in some form of taxation as a result, and also been required to change the way they tax expats living and working abroad. Thailand have now proposed that from 2024 there's a new tax regime. So an expat could live in Thailand paying tax on a remittance basis, but that is changing from 2024. Any worldwide income that's earned is deemed to be remitted into Thailand and therefore becomes taxable. Even if you've earned the income in 2023, if you bring it into Thailand, it's classed as income in that year. So from 2024, you can declare your full income as a Thai tax resident for that year. But if you want to defer some of the income because you've not remitted it, when you do bring it in and spend it, it'll be taxable then. So there's still some strategies that you can use to defer tax liabilities, but in effect, an expat that's living and working in Thailand for more than 6 months in a year has a tax return liability as a tax resident and must declare their worldwide income, definitely what's remitted worldwide from worldwide into Thailand, although you've still got this option to defer it for a couple of years if you want. It's a big change. If you're an expat living and working in Thailand and you want help and guidance on tax registration and returns, contact us at proactpartnership.com. Thanks a lot for listening. You can always contact Proact at proactpartnership.com. You can contact us, or you can book online. We do a consultant review where you can pay for a consultation and get direct, real answers to your work. If you want it written down, it takes us a bit longer. We have to do a bit more research, it costs a bit more money, but we can do a written report as well. But also we can, as well as advice meetings and written reports, we can do the tax returns for you. So if you've got a split year issue, a tax return issue, or a tax registration issue, whether it's for business, personal, social, national insurance, contact us at proactpartnership.com and we can help you, an expat living and working abroad. Thanks a lot for listening, and we'll see you next time.